YouTube is now the world's largest media company, surpassing Disney for the first time ever. And who's in third place? Netflix. I happen to hold all three of these companies in my portfolio. So today we're going to be taking a look at what the future holds for them. We'll be breaking down what happened, why YouTube growth matters for Google, and how I'm thinking about how these stocks fit into my portfolio for the long term. So let's take a look at this article. YouTube lays claim to another crown. YouTube has generated more than $62 billion in revenue in 2025, beating Disney, who came in at $60.9 billion. This means that the platform you're watching right now has officially become the largest media company in the world. YouTube is now the king of all media. There's a few things that are driving this shift. YouTube ad revenue alone is $40 billion. YouTube TV subscriptions continue to grow. Analysts estimate that YouTube's standalone value is between $500 billion and $560 billion. And here's the real difference between YouTube and other traditional media companies. YouTube is running on creator-driven content instead of $1 billion studio. I have to build this myself. So this means lower costs, massive scale, and constant new content. So basically built-in low overhead. So now let's talk about Google, because YouTube is one of the most important assets inside of Alphabet, aka Google. And this is where long-term investors should be paying attention. When it comes to my Google position, I'm currently holding a little over 25 shares and I'm up about 124%. I have an average price of $137.55, and the current stock price has recently pulled back. It's right now at 307. Over the last year, it's up 85%. So when it comes to Google, the 52-week high has been $349. But recently it's been trading closer to the $300 range. This is because of the amount of money Google is spending. They have recently forecast for 2026 to spend between $175 billion and $185 billion when it comes to AI. This is nearly double what they spent just a year ago. And this causes investors to be worried about the amount of cash that they're putting behind AI on data centers, AI chips, basically things that will eat into the company's profit margins in the short term. Like other companies, another obstacle is, even though they beat when it comes to earnings, many are looking for even more impressive numbers. And another issue is that some investors are shifting out of software companies like Google and Microsoft into more hardware-focused companies like NVIDIA. And when it comes to Google, analysts are currently giving it an average price target of about $380. So when it comes to Google, this was already a buy and hold investment when it comes to my portfolio. And I will be continuing to hold. And I love what's going on with YouTube when it comes to being the world's largest media company, integrating AI tools, thriving when it comes to advertising, being on track to overtake TV leaders like Charter and Comcast. YouTube TV now has around 10 million subscriptions. So it's basically a cable provider also. Now, before we move on to the Disney news of the day, let's take a look at two ETFs, VOO and VUG, for those of us who love getting our exposure to these different companies through funds. VOO, which tracks the S&P 500, has both Google classes in the top 10 with a weighting of about 6%. And VUG, Vanguard's growth ETF, also has both Google classes in the top 10, giving you exposure to about 11% when it comes to Google. Now, let's take a look at Disney, and I zoomed way out on this one. So the 5-year, it's down 48.61%. Over the last year, down 1.7%. And year to date, down 10.94%. This is totally different than YouTube. Disney has to spend billions creating movies and shows, while YouTube creators produce the content and Google just gets to monetize the platform. This has been a great benefit to Google. Looking at Disney stock price, it looks like they're losing really badly, but this is not the whole story. Disney still generated $60.9 billion in media revenue, which is very substantial. But the biggest shift is that Disney used to be the center of the entertainment universe, but today it's competing with many other platforms. And when it comes to Disney, I have not cut it completely from my portfolio. I'm still holding 5 shares. I'm down 12.73%, and I have an average cost of $116.32. I have sold some shares, but it wasn't a panic sell. I decided to shift it over to Netflix, which we'll be taking a look at next. When it comes to Disney, analysts are giving it an average price target of $135.41. In their last earnings, they did beat the expectations and are expected to be on track to have $25 billion in revenue later on this year. When it comes to Disney, their parks and experiences is still strong and profitable, but their streaming is not growing at the rate that YouTube is. It's a very small position now. Like I said, just 5 shares, and I'll be just holding on to those for now. Now on to Netflix. And I wanted to touch on this one because behind YouTube and Disney, Netflix is the closest competitor. It's worth about $409 billion. I just recently added Netflix to my portfolio a few months ago, right before the stock split and their attempt at acquiring Warner Brothers. I picked up 1 share at that time, which then split into 10. I haven't added much to my portfolio. I'm only holding 10.25 shares, and I'm down about 13% with an average price of $111.44. Analysts are currently giving Netflix an average price target of $114.79. Netflix is a key player when it comes to media and streaming. People are shifting towards ad-supported platforms, live content, as well as creator-driven content. And Netflix is making strides to adapt in all of these areas, like live events, sports, and even gaming. So Netflix is still the king of premium streaming content. YouTube is the king of all video, but they're both in very different lanes. Overall, we've seen a major shift in the way that the media industry operates. For most of our lifetimes, we saw a model of TV studios creating TV shows and then a network distribute them. Today's model is more like a creator creates content and then platforms find a way to scale and distribute it globally. And YouTube is definitely winning when it comes to this, giving us all of these different elements in one ecosystem. So when it comes to the shares that I'm holding, Google will continue to be one of my long-term growth positions. I'll be holding on to my Netflix to give it time to recover from everything that's gone on in the last couple of months. And for now, still holding those few shares of Disney, waiting and seeing if they get things turned around and adapt like YouTube and Netflix have. Thanks for watching. Make sure to leave me some comments. Let me know your thoughts. Do you hold any of these companies in your portfolio? Have you had Disney and Netflix in your portfolio for a while and have seen strong gains and just a pullback when it comes to your position? Is your Google position thriving, or are you someone who's just getting exposure to these big names through your ETFs? If you're not already, make sure to subscribe, like, hit that notification bell, hype this video. Thanks for watching. Okay, bye.